Hi everyone, today we're extending our discussion about the golden rule in investing. That is, buy low, sell high. Over time, some of the best returns in the stock market come when sentiment is the lowest. That is, when your neighbor comes up to you and tells you they heard the stock market's going to zero, that might be a sign to invest. Over time, buying fear has worked really well for investors. And here I'm going to show some examples of that. On this graph here is a US investor survey. Every week this survey goes out and asks investors whether they think the market's going to go down, up, or stay the same over the next 6 months. And this chart plots the percentage of respondents that said the market was going to go down over the next 6 months. And what you can see is that when the majority of investors are expecting the market to go down, that's these peaks you see in the investor survey, this is when you get some of the best rallies in stock market history. For example, in the depths of the financial crisis in March 2009, it was the highest reading ever for negative sentiment, and it was the best subsequent returns in the stock market in a generation. So in all of these periods, you can see highlighted here, when you buy sentiment that's most negative, often you can get some really fantastic stock market returns. Now, you may think, okay, buying fear is a good thing. What about selling when there's a lot of optimism in the market? Now, that is much tougher. Often, to continue the earlier example, if your neighbor comes to you and tells you that the stock market's on a tear, it's going up for sure, often the stock market does go up in those instances. So it is harder to sell optimism because the stock market over time typically rises, but buying low when sentiment is negative has a quite good track record, and that has typically worked over time. So the best advice is when sentiment declines and others are fearful, that's typically a good time to think about investing.